Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 20 minutes here. We don't have any trades from last week that we're going to look at. We did quite a few earnings trades, mixed results, I guess, in general. So far, it's been a pretty good earnings season. And last week's trades depended on when you got out of the trades. They didn't go perfectly, but there were chances, more opportunities to make a profit than to lose on those positions. So I'd call it a solid week last week as far as earnings are concerned. But earnings are always going to come with risks, and they're always going to come with high rewards. So with that said, as I mentioned on Friday's show, we're going to look at a VIX trade, and we're getting into September and October. So I'm going to actually propose something a little bit new this week in that August was a scary month for the VIX last year. Last year, the most of the volatility came in August, but September and October did not disappoint. I think the market's being a little frothy right now. It's a solid setup for this. But I'm going to look at selling some premium in August to help pay for some premium in September. The thing that has been annoying to me is that the September and October futures contracts for the VIX just won't come down. They won't come down below the 20 level. I've been watching them periodically every couple of days, taking a peek at it to see if those futures contracts will come down. And no matter where the VIX is at, it just doesn't seem to happen. And today we got an odd anomaly going on in that we have the S&P 500 index right now up 1.2%, and we see the VIX up 3 points or 15%, trading at 1942 right now. And then we have the VVIX actually down, and it's trading below 100 at 99.74. So very odd dynamic as far as the VIX and the SPX is concerned. Very rarely do you get the SPX up 1.5% and the VIX up as much as it is. It just doesn't happen that often. And a lot of times what that means to me, but this is just a one-off indicator, is that the SPX might be down by the end of the day, that the market participants don't necessarily believe in the move to the upside, that there is some news out there that they're anticipating that could drive the markets lower. There's a lot of reasons why it can happen, and as one individual indicator in a vacuum, that's the VIX being up 3 points with the S&P 500 index up 1.2%. is a scary notion for the markets. Now, the VVIX coming back down is 30-day volatility in the VIX index. It's the VIX of the VIX. Is also surprising to get the VIX make the big run up and the VVIX doesn't follow along with it. So just odd. A lot of odd things going on. So I am going to sell some of that premium, this little bump up that we got in the VIX, and we're going to look at that August contract. Now, the August contract, which is this, I never like to look at the weeklies, and I've mentioned that before. The volume and the tight markets are in the actual monthly VIX index that always expires on a Wednesday, and this one for August is going to be the 20th. And it's highlighted by the fact that you have a green symbol here without a W, hinting that that is for the weeklies. So let's go on in and let's start looking at the actual VIX chains. So here's the August 20th, and here is the VIX index, 16 days away. And we're looking at right now, using delayed futures quotes on the CBOE, it says it's $18.55. We can confirm that. So it's below where the actual VIX is at right now, which is 1942. It's showing that the futures contracts are anticipating it actually being lower than where the VIX is at right now. And I think we're going to take advantage of selling some of that premium. So it's right in between 1850 and 19, which means that if you look at the 1850 strike call, we're just looking at the bid here. $1.52. You look at that on the puts a little bit less, $1.48. Then you go up to 19, and you see that the asking price on the The asking price on the put option is now higher, and the asking price on the call option is now lower. So it's confirming that the underlying is actually trading somewhere between 1850 and 1900. And that's just something called put call parity. And then I also look at the VIX, the Chicago Board Option Exchange, CBOE.com has delayed futures quotes on the VIX. And there you are. Here's where we're at. So let's sell something. Market's here, 1850. Let's sell. Where do we think? I think we could stay above 17 and 15, 40 cents for 2 points wide. Okay. So let's sell this one. And we'll go down to 15, and that's trading for 6 cents. And buy this one. Okay. 55 cents. I don't mind that at all. All right. So we're going to go out. This is going to be the first step in our VIX trade. We're going to sell some premium in the short term. This trade does make me a little bit nervous. The VIX has hung around the 15, 16 level for some time. But we're going to get bullish, and I don't necessarily want to. I mean, we could sell the 1650, which is this one right here. That's still 40 cents and bring in 30 cents. But this is real money, 55 cents for a 2-point wide trade. Our max risk would then be $1.45. Max upside is going to be 55 cents. Let's put this in the what if calculator just so that we can store it. And that's going to bring in 55 cents. Now I want to go out and buy some premium. So we're going to go out to the September contract. And if I take a quick peek over at my delayed quotes on CBOE.com, I see that the 17th, which is 44 days away, that futures contract is now trading at $20.40. Like I said, I've been waiting for that futures to come down below 19. If I got towards the 19 level, then I was going to look to buy some premium, do a spread, do something to get bullish in that September contract. But I never really saw it. Every time I took a peek at it, I had a real tough time breaking down below 20 in that futures contract. So right now the market is at 2040. So how do we make sure that's right? This is delayed, right? Well, 2050 should be almost the exact same price. The call option on the ask is 241. The call option on the bid is 254. So 13 cents difference. Yep, that implies that it's probably pretty close to the $20.40 that is the delayed futures quote over on CBOE.com. So how do we want to trade this? I want to get bullish on this expiration in particular. And once you start drifting up on calls, they really don't get that much cheaper. So the question is, do you want to do a bull call spread, or would you prefer to just buy an option contract outright? We sold an option hoping that we could collect that premium, which is about 55 cents. And now I think I want to buy an option contract. Now, this is going to get a little bit convoluted in that I want to buy the contract, remain long it for the next few days, and then potentially sell something against it at a later date. But I just want to be long an option contract. I want to be long the VIX options, and I want to be long that going into September. So I could wait a little bit on this trade. I don't mind just selling the August contract and just let it wither away. But I'm going to put this trade on right now. So now in my own personal account, I'm probably going to wait to before I'm going to go out and buy that September contract. But today I want to sell a shorter term short put spread, take some of those proceeds to cheapen my long option contract. And I like the 22 level. So I'm going to buy the August contract to go along with this. So we sent that to the what if calculator. We can go actually this. Let's add this leg, and it will add it below and show you the total cost. Okay, Now I'm going to separate them, and I don't necessarily think I would send it to the floor as a 1 by 1 trade, but there's no reason why you can't. Just because it's multiple expiration doesn't mean you can't send this to the floor as a 3-legged trade. Most people won't. Most people would sell the put spread and then go out and buy the long call. So in this instance, total cost is going to be 150. Let's send that to the what if calculator. And then we'll come back, and here's what would be the second trade here. Just be buying the 22 call, midpoint's $2.04, very tight markets as usual. Large open interest in the VIX monthly contract. Guess this is it, September 17th. 44 days remaining, $2.04. I don't mind putting all the trade on today, but what I will personally do is sell that short put spread and then eventually wait and look for the time on the VIX. I'm not going to wait all the way to that August expiration date, but I don't necessarily need to do it right now. 44 days is a lot of time premium to pay, and we're going to try to wither away at that time premium by selling a short put spread. Hopefully that expires worthless, and then that allows us just to remain long this call. And in the short term, I do expect volatility. The marketplace is expecting volatility. I'm taking advantage of the fact that the VIX actually ran up today. We still have a lot of earnings. Most of the mega cap tech stocks have announced. There's NVIDIA is at the end of the quarter as far as quarterly earnings is concerned, or at the end of the event, I guess is a better way to say it. And so we will now look at a trade in Caterpillar. And here's part of the reason why I like to trade in Caterpillar. There's two reasons. Well, there's one reason why I don't, and one reason why I do. All right. Symbol CAT. They make it simple for you. And it's a $435 stock. So you have earnings, you have pumped up implied volatility, you have a $435 stock. We're going to go out about 1 standard deviation move, and we're going to do our skip strike. They're announcing before the open tomorrow, and that creates an issue in that you have all day Tuesday, all day Wednesday, all day Thursday, all day Friday before these option contracts expire on August 8th. So I've always mentioned this, when you're doing butterflies, I'd rather be closer. I'd rather have them announce on a Wednesday or have them announce on a Thursday like Amazon always does. And I would prefer to do it that way if you can. But they're announcing tomorrow, and the stock has, once again, parabolic is the only word you can use. Look at that move up. So they're going to have to blow the doors out in order to continue on up. I mean, they broke through this high and they didn't even pause. Or I should say the underlying stock didn't even pause. Look at that move. Well, I guess it did. We got 3 days, right, before it just decided, nope, we're going higher. And then went another about 3% higher to the upside. So from here, boom, 420. Now we're at 435. And now we're consolidating again. All the ducks are in a row. We got the 200-day below the 20 or 50-day below the 20-day, and straight up. So their earnings are going. They trade at a solid PE relative to the rest of the industry. Obviously, a stalwart U.S. company. Overseas is doing okay. So there is tariff risk that is available, but the stock has just been able to ignore the marketplace has been able to ignore that risk. So trades at about 21 PE right now. So that's a decent valuation. It's not overpriced, not anything crazy as far as the market is concerned. And we're going to do a skip strike butterfly. Okay. So August 4th, shortest expiration. I think I got one in the what if calculator. Yep. Here it is. And we're going to take this, send that to ticket. 25 cents. Dang it. That was just 40 cents. Market moved on me. Really want 40 cents. I don't want 25. Buy one, sell one. I don't know if it's moved that much. 24. All right. So the goal when I'm ever looking at the butterflies, right now we're 5 points wide. We're skipping the strike. So we're going to go out to the August 8th expiration. We're going to go about the expected move out of the money. And that's the first option that we buy. That's 455 strike, the delta's around 20. One standard deviation move, meaning that it has to go beyond that before the trade gets a little nervous. You get a little nervous about that trade, and that's at 1634, and then all the way down to where our skip strike, where our max risk occurs, is all the way down, and that's an 8 delta, the 8% chance by this Friday that this could be trading 1 cent in the money. Now, its earnings kind of skews the math a little bit because there's obviously a big catalyst, and nobody knows exactly what the catalyst is, but based off of this, based off of the deltas, these are the probabilities, and this is what we have to work with. Now, this was 35 cents when I put the trade together, and that's usually about right. So we're 5 points wide in risk, and let's go back to the what if calculator and see. We see our max risk here is 5 points. Now it's grabbing the 23 cents, so it's saying your max risk is $473, and that's very true. Now, if I'd want to do this trade, and I would work it, I might even skew it to the downside a little bit more, but I would try to get 40 cents on this. And if you $40 on 500 of risk is 8%, $25 on 500 of risk is 5%. So that's not bad. We could do a couple of them. I swear it was 34 not that long ago. So this is going to be the official paper trade. We'll leave it right there. So this is our official paper trade on Caterpillar. We're going to be buying the August 8th expiration, 455 strike call, sell 2 of the 460 strike calls, and then buy 1 of the 470 strike calls. We're going to do this for a net debit. Let's call it, or a net credit. Let's call it 425. Let's go 25 cents of 25 cents. I would like to work it. I would put it in at 30 to start at least, and then maybe adjust this trade. But earnings is tomorrow. So you have all the way up until the close to put it on, but I would work it a little bit, see if I could get 30 cents. And I like this trade. I like this trade. My only downside or my only hesitation is that they're announcing on the open tomorrow, and you have 4 whole days before the expiration of the contracts. And so to start with, this green line is the way time decay is going to work. The announcement's going to come out. Implied volatility is going to come in, like it usually does 99% of the time. And implied volatility is going to start creeping this line up. As that goes down, that line's going to go up. Every day that goes by, you're going to get time decay. But bottom line is if it opens tomorrow and it's right at that strike, you'd be down at that on this position, right? Because there's not enough time decay. There's not enough volatility crunch that can move this line that much that way. So you got to hope that ideally we're doing this as an alternative to a short spread. So we want to bring that net credit in with $500 worth of risk. We're going to bring in $25. And for every 1 by 2 by 1 skip strike butterfly that we do. So that's our ultimate goal. If we get lucky and the stock comes this direction, and your ideal scenario would be that it opens about half of the expected move, and it does that to the upside and then creeps slowly over the week towards this point to the peak of our butterfly. That would be the ideal scenario. But to start with, you do not want it to blow the doors out of the water. It's got to go all the way up to 470 to get to the worst case scenario. And like I said, Delta is saying that there's a less than a 10% chance of it finishing 1 cent in the money at that expiration date. All right. Take a quick peek, see if we have any questions. We do got a comment. Well, good morning to you, Kurt. Appreciate that. We got things rocking and rolling in the earnings world. The volatility, interesting today, right? Just interesting. 1903 VIX SPX is now up 1.5%. I mean, an interesting day trade is to just get short the SPX or even the SPY. Maybe we'll put that on and we'll look at it. Okay, so this is the official paper trade. My 2 official trades are going to be, we sold, and not meant to be a recommendation. When I say official, it's just these are the trades that we're going to review on going over time. sold the short put spread in the VIX using the August expiration to try to help pay for our September expiration long call. Second, we're going to look at an earnings play, a skip strike butterfly in Caterpillar. That's going to be our long, ideally, this is an alternative to a short spread. So we want to realize that we're just trying to make the credit as much as possible. But if we get a little bit of a bonus and it does behave a little bit and ends up somewhere within our strikes, we could make more than just the net credit. And then lastly, let's look at a SPY trade. We've got a few minutes left in the show. Said we'd be a little bit shorter, but I kind of feel like going into the markets, we might see the marketplace come back down a little. It's up 1.1%. It was 1.2% when we started. Let's straddle the market. Let's just do a very not inexpensive straddle of the market, in that we're going to buy the 631 put, and then we're going to go 2 points out of the money, and we're going to sell the 627. No, one's got to be a buy. $165. Yeah, I don't mind that. What, 629? 165 to make 4. Right? So you can make almost 2 to 1, $2.35 versus risking $1.66. That's going to be just a short, fun little paper trade. I'll add that to the what if calculator, take a screenshot, see what happens today. See if the market, literally just a bet, is the market going to go up as we go into the close, or is it going to go down? That's simple. All right, that's it for this edition of Options Guy TV. Thanks for stopping in, and we'll see you on Wednesday to see how our trade did in Caterpillar around earnings. And we'll keep the VIX trade in the back burner. We'll be watching that over the next 40 days, actually, to get all the way up to the September contract. And we'll see, why is the VIX index up with the S&P 500 index up over 1%? So we'll see if we can answer that mystery. We'll see you for the next edition this Wednesday at 11 a.m. Eastern Time. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.